Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here today with a return guest to the show of Olden Lane, Mike Macchiarola. Mike, how you doing today?
Doing great.
Glad to hear it. Yeah, interesting times. We had a little pre-chat. Maybe we'll talk about some of the pre-chat here on the call, but I get your newsletter. I follow you guys on LinkedIn, and you had an interesting article, your newsletter for January that caught my eye, called the 10 themes for the new year. And I reached out and thought, hey, let's walk through these on a podcast. You hadn't been on for a few months. Wanted to get you back on the show. And Mike, for people who might not have listened to some of your other shows that I've had you on or are not familiar with Olden Lane, could you give your background and a little description of what Olden Lane does for the credit union world?
Sure. Thanks for having me on, Mark. Really appreciate it. Olden Lane is a broker-dealer and a registered investment advisor, but really what we are is a boutique investment bank that meets the needs of credit unions exclusively. We're unique in that sense. To our knowledge, we're the only one who has that charge. We've really cut our teeth or made our name to the extent that we have in the subordinated debt market. We've been in that game since about 2018 or so, and have now brought more than 50 clients through that process successfully. We've raised more than $1 billion of approvals and raised that almost that much in actual dollars, all for low income credit unions. Although that rule's expanded, we're yet to see anyone in the industry other than a like who raise money. That's a curious thing. And increasingly, in the most recent period, we've been in the M&A game. Our biggest deal to date has been the Keesler-Jefferson merger that was announced end of last year. That's just about finishing up its regulatory approval process. And we just announced at the beginning of this year the first full bank purchase by a credit union in the state of California. That's a front wave transaction, buying Community Valley Bank's assets. So we're excited about that. It's taken us some time to get our team totally aligned with both of those verticals, but we are now full steam ahead in both business lines and excited to be servicing the credit union community.
Yeah, just in time, because I think mergers, actually, we had that on the list here. Mergers, I'm hearing a lot of chatter from my credit union conversations, both with clients and non-clients. And the stats, I think, show that. We'll get to that here in a
Oh,
few
yes.
minutes, most likely. The article newsletter is laid out greatly. I'm just going to walk through the specific topics and let me know what your thoughts are on what the newsletter said or anything else related to that, because things change quick. That was the January newsletter. Here we are in early February, and there's a lot going on in the world in so many ways. All right, so the first topic on the newsletter is higher for longer. Let's talk about higher for longer. And without going back and reading it, I'm sure rates have something to do with this. Mike, let's chat about
Yes,
that.
sir. So let's paint the historical picture first, right? So we had a benign interest rate era for a good decade where we didn't have to concern ourselves too much with the traditional metrics that a banker cares the most about, which is what's going in my front door and what's going out my back door. With interest rates benign or basically at zero, close there too, the effects were not felt as broadly as they might otherwise be when they were more around. What happened is we ended up in a 2.5 year period ending in October of last year where the twos and tens were inverted. An inverted yield curve is not a friend of financial institution because essentially we typically borrow short and lend long, and an inverted yield curve makes that not so profitable of an exercise. That inversion unwound the end of last year as the rate cutting set in at the Fed. What's interesting here is that everybody was optimistic that the rate cutting would take a lot of the pressure off of the 500 points of rate increases that have been going on for the last 2 years. But what's happened here is since September of 24, Fed funds rate at that point was at 5.5. They cut 100 basis points and brought Fed funds to 4.5. But during that time, the 10-year rate rose in the face of that from 365 to basically 445, where it is today. So we've had 100 basis points of cutting and 100 basis points of interest rate effects on the 10-year going higher. That is made it difficult for those who thought that those cuts would be beneficial and would take some of the pain off of the cost of funds. The average cost of funds, in light of all those moves, has continued to rise in the industry, settling at around 218 in Q4. And just to give you ballpark, that's up from a 58 basis point level industry wide in the 2 year ago period of Q4 of 2022. So absorbing more than 150 basis points of increase on your cost of funds has obviously put pressure on credit unions. The fact that the rates have stayed high here is also going to have create an acute problem for some, because by the estimates of Callahan, about 80% of the CDs that are out in the industry are expected to roll over by September of this year. If they roll over and you don't get a benefit of the repricing because rates have not moved back in, it's going to hurt more than many had expected. So that's why you're seeing pressure that comes from this interest rate environment. And it's stressing many credit unions very acutely at this point.
Yeah, a lot of variables here, but when you walk through that, and I put my old examiner hat on, and I'm thinking of a credit union that might have some pressures already on profitability, and they're having to pay 150 basis points more. Maybe they're making up 100 of that on the loan side, maybe not. And then they're going, okay, where can I cut on my operating expenses? And the operating expenses, they've got their data processing contract locked up for X number of years, visas locked up for X number of years. They just lost their CFO to the bigger credit union down the street. They're looking out at the market. You've got inflation, which is impacting salaries, and you find yourself in this robbing from Peter to pay Paul to figure out what that budget is going to be to show that you can break even or make half of what you made 2 years ago, et cetera, et cetera. So I think that's probably a challenge that a lot of credit unions are dealing with out there because of what's going on with the higher for longer potentially. Any thoughts on that?
Yeah, you've hit it. You've hit the nail on the head. None of these can be seen in isolation, right? So all of them mix together. And you're right. We're an industry of gentlemen and gentle ladies, so we tread lightly on headcount. And so that lever is pulled reluctantly if it's pulled. And we saw a big announcement today of a headcount reduction at a big credit union. We're going to continue to see those. Those are done reluctantly. I will tell you, when we start, and I don't want to jump the gun to the M&A discussion that I'm sure we'll have, but
You already jumped at the profitability.
Yeah.
Sorry about that, but yeah.
That's okay. But when we start to screen for those M&A client potential merging credit unions, if you will, one of the things we look for is if their liabilities have not yet repriced. That is, they're inside that 218 and they're struggling to gain profitability. It's only going to get worse when those CDs and share certificates or their members ask for more rate. And if you can't make it work when you're inside the 218 industry level, it's going to be really hard when you catch up to peer group. The other thing is, if your OpEx is already inside peer group and there's not anything left, you're cutting now into bone, right? So there are plenty of credit unions that are suffering, and honestly, the levers are not there to pull. The other thing is there are some one-time levers, right? We've gone through a couple episodes where we've seen the sale leaseback. We've seen the sale of Visa B shares. Those trades are only available once. We've seen the sale of a headquarters. But when you start to pull on those, you've pulled on your rainy day fund, and you're now stuck with some choices that are not great. And as you and I talked about in a couple episodes ago, when you're in that position, your menu, your option set as a potential target in M&A shrinks. And so you don't want to get yourself to the M&A discussion when you don't have the full panoply of options in front of you.
You got that right. Yeah, and in those one-time profit-saving events, NCUA heavily discounts those and says, that's great. What have you done for me lately, and what's your core profitability? So you're spot on that. And one of the other levers historically has been tweaking your fee income, whether in the old days you could say, you'd have a credit union that had had to put together a net worth restoration plan. They'd say, yeah, let's raise our NSF fees $5. Let's raise our overdraft fees $5. We'll put a fee on this. we'll start charging fees to get out inactive accounts, and that'll help us restore our capital. And so that gets us to topic 2, regulatory pressure on fees.
Yes. Some good news here. A couple things. Number one is you just hit capital. So capital's at great levels. The industry's strong. The net worth ratio across the industry is strong, but we always caution folks that median net worth and mean net worth industry-wide is of little relevance to a particular credit union at a particular moment in time. So my father used to always say, there's only one unemployment rate. It's either 0 or 100. You either have a job or you don't. It's the same essentially for the capital level of a credit union. You really don't care so much about everyone else. You care about yourself.
Right.
But the fee pressure, this is good news, right? So the fee pressure has been coming for a while. It's been coming largely from the CFPB, and it's been pretty significant. Now, the NCUA got in on the act a couple of different ways. The first was that the 5,300 reporting since the beginning of last year for those above $1 billion level has included a breakout of NSF and OD fees. And then the second way that the NCUA got involved was their letter to credit unions 24-03, which was about unfair and abusive and deceptive practices and fees. So it looked as if they were getting harmonized with the CFPB, which is terrific from a regulatory standpoint. And all of that probably slow, thanks to the Trump administration's approach to the CFPB, right? Last week, they appointed Treasury Secretary Bessent as the acting CF director. That seems to indicate that they are going to treat it much like they did last time with Mick Mulvaney, essentially put it to sleep. That should mean that the regulatory pressure coming on the fee side should ease. The other thing that's happened, obviously, is that we've changed the chairman at the NCUA. And my bet is that fees, in light of the political structure and the change of guard there, are not going to be top of the list. Now, I don't think it's going away. I think more than ever, we've seen sort of constructive work. I think credit unions' own approach and own appetite for NSF and OD fees has changed a little bit here.
Right.
So I think it will have a persistence. It will be sticky, which is probably good. But here is where I take a little bit of exception to the NCUA. They did a research note that they released a couple weeks ago, and I appreciate what they're trying to do. They're trying to really measure the sensitivity of fees and what's going on, but they make vast, sweeping conclusions based on a very small data set for a very small universe of credit unions. And they try to extrapolate from 3/4 of data what's going on under the hood. There's no allowance for the fact that many of those institutions cater to very different regions, very different groups. Some face the underserved in a big way, some not so much, just based on geography and historical presence. And so I think we've got to hesitate before we draw massive conclusions from a very small sample of data.
You said that very nicely. I need to go back and look at that data because I was chatting with one of my team members who said, "Hey, have you looked at that?" I said, "I saw the headlines," and he had already read it, and he said what you said, but then went on to say, the economist at NCUA said we can't draw conclusions of X, Y, and Z on this, and then the former chairman Harper went on and drew some conclusions from some limited data. And he's very passionate about that topic. So he highlighted what he could highlight to help make his point. The pivot point to the new chairman, we're recording this on Wednesday, first Wednesday of February. The priority letter to NCUA also refers to overdrafts and consumer compliance and things like that. That was issued by Harper. Tomorrow, NCUA is doing a webinar on the priority letter. Typically, those are kicked off by the chairman. So I'll put a link in the show notes. Here's what the Helpman administration might mean to credit unions. But one of the things I posed was, what is he going to do? Is he going to skip that meeting? Is he going to cancel the meeting? Is he going to go into it and saying we're canceling the letter, which he has the authority to do because he's the spokesperson for the agency, so he could cancel those if he wants to? Or is he going to say we're looking at it and we're going to have a softer touch on overdrafts than we implicated there? And this is where, when I was at NCUA, if I was there right now, I would get calls from the regional directors saying, hey, Mark, the priority letter says we're supposed to do this, and
Yep.
we haven't pulled the letter, and the Trump administration is saying this, and the CFPB is saying this. My examiners need to know how to deal with overdrafts on the exam. And until I could get a commitment from the board, you'd have to tell them it's in flux. It's not a good answer while you're sending examiners out there, because they like clarity and the credit unions need clarity. So that stickiness is there, because that's one of the things that leads to that stickiness too, is they're going to get unclear guidance from NCUA until NCUA either says, okay, that's off the table. Our letter that we wrote last year is off the table, which again Hauptmann can do, or he can put his own he put his own priorities out, which were a big picture priority, but that letter is still out there saying they're going to do A, B, and C. And then they've got, now I'm going down a rabbit hole. They have an internal instruction that issues what their scope is for their exams. Nobody knows what it is, but internally. And some chairmans look at that, some chairmans don't. Kyle Hauptmann, if you're listening, you should look at that and see if it's consistent with what you want the scope to be. All right.
Yep. No, it's in flux, and we'll get to that. I have a lot.
I keep you're gonna say we'll get to that when we get later. I have a hard time keeping these things.
No, it's like I
through them.
said, it's a soup. It all mixes
is.
together. The other thing on the fees is we cannot, as an industry, get to a place where the words non-sufficient funds or overdraft are we just can't. We have to make allowance for the fact that this industry reaches different demographics and different folks at different parts of the ladder. And so there are particular credit unions where we work with the people, and I can assure you they have the greatest heart and the greatest tolerance, but they are in a place where their riskiness dictates a certain fee expectation that if they just took it away, they would threaten their business, their franchise. And then you'd be in a place where people who need those financial services and the delivery of those products and services would be just out of luck. We can't do that.
And a guy who needs to get a replacement tire, it could be a used tire, right? He has to get a used tire for his truck so he can go out to work, so he can put food on the family table, is better off getting an NSF fee than going to the predatory lenders that are out there. And that is a service that we can't let credit unions get away from. And the hyper focus, in my opinion, the hyper focus on fees of the Biden administration was getting dangerously close to actually harming people when it was trying to do good.
I think it could be intellectually lazy to paint every credit union and every style in every region with the same brush. Again, the data will tell you some things, and you've got to be careful, and you can't read them too broadly. But at the same time, you have to have a heart here somewhere underneath and make allowance for customization.
Another non sequitur, you reminded me of a former NCUA attorney who retired, and at his retirement party, he said he was a lazy genius. And you know what? He was right. I never he's a great guy, a smart guy. I enjoyed chatting with him, but he nailed it. He knew it. If by the time you're at the end of your career, hopefully you can know yourself, and he knew himself.
Self-assessment. Yeah, it's important.
Right. So that's a good pivot to the strained consumer, which is up next. Let's chat about the strained consumer and the impact that's having on our soup that we're building here today.
Look, you could stop at any moment in time and throw the towel in on the U.S. consumer, but you'd be wrong most of the time. So there always just seems to be a tolerance for more, right? I open the household credit report from the Federal Reserve, and my eyes bulge out of my head when I see $17.94 trillion of household debt. When I look at the California line and I look at debt encumbrance at 90,000 per person, and I say, what does that mean? We had a big discussion in the office the other day about that. All I know is California is a good 15,000 higher than the next Illinois. So congratulations. But again, at what point do you truly throw the towel in? I will caution that when it comes to credit, when you go up in an elevator and you go down in an escalator, here we are. 11% of credit card balances in the US are 90 days or more delinquent. That makes the hair on the back of my neck stand up. But you know what? Here we are. There's been a significant drop and a continued drop quarter over quarter in personal savings rate. Where it really expresses itself for credit unions, the delinquency line's getting to be a little ugly. It has been running now all the way since Q1 of 2022, where it bottomed out at 42 basis points. At the time, we were ringing the bell here that there may be a spring effect in those numbers because all the moratoria that had been building. And I think we're seeing it. I think the chickens are coming home to roost. We're at 97 basis points in the most recent quarter here, and it's causing acute stresses in pockets. You're seeing some of the bigger credit unions that tend to have commercial real estate exposure. There's some serious issues in a couple places. Some of the credit unions who were addicted to growth in a certain sense in the last few periods have gone out on a binge on the consumer unsecured, where you've seen a lot of stress. And I think in the auto patch, in certain pockets, you're seeing some softness. And the word here is just be careful. I would, like I said, I'm not going to call the end of the day or ring the bell, but the consumer is under stress, and just know that lurks in the background of everything you're trying to do as a credit union, which is going to segue us right into the next one, which is loan growth.
Yeah. So the challenging environment for loan growth, let's speak to that.
Yeah. Here, it looks like, and the last credit unions are still reporting, but it looks like we're going to be right around 5% growth of loans in Q4, which reverses a quarter over quarter decline that's been in the market for a while, for about 2 years. So I don't know whether that's an anomalous piece of data. I don't know if it's yet bottomed out and we're going to see growth. I do think we want to look for loan growth coming off an environment that was tight on the liquidity side, and that should be easing, where interest rates have probably bottomed, topped, so that effect should be bearing off. And you're certainly going to get pro-growth posture and less regulatory posture across a large swath of industries, which should encourage typical lending activity and growth in the broader economy. I do think you're going to see some loan growth here. I think it will take a little bit time to lag in, but I definitely am more bullish on loan growth, and that has knock-on effects as well. I think that will, more than anything else, I think that will wake back up the sub-debt market, because as much as people will complain about interest rate, the absolute level of interest rates is irrelevant when you've priced in both sides of the balance sheet and we've found a new level of normalization. What's more important in my mind is, do you have true visibility and belief in your loan growth? Because if you can see that and you understand that you have pricing room, then you can project out that you can grow into a levered balance sheet, and an appropriate amount of sub debt is probably in order for many institutions that have been waiting it out.
Yeah. When I think of that too, I'm wondering, you can't paint with the broad brush, right? That's the average. Where is it happening? Are there states where it's 2%? Are there states where it's 10%? Where are the winners and losers individually? But to see the number going in the right direction, hopefully that trend will continue. So the next up, we talked about profitability, but profitability is getting squeezed. General thoughts in addition to what we might have already said?
Yeah, here it's all of the stresses we've identified. It's a little bit of credit deterioration. It's probably, we're feeling the effects of some lax underwriting standards, some reaching for growth and or yield, some tighter liquidity, some underwater investments that continue to mature or roll off, but are doing it slowly. And the underwaterness, if you will, is as high as it's ever been, because the interest rate rip was as fast and as aggressive as it's ever been. We're chewing through it and we're being constructive. I'm just worried that not everyone's going to get to the other side. If you look at the absolute level of return on assets, 64 basis points. But again, there's a pretty significant variance. We're doing some work here. We're not through it yet, to understand both geography, where that cuts, and I think also size matters here, and not as much as you think in the positive way. Being bigger here can be more dangerous because they can wear bigger risks, and some of those bigger deteriorations on credit are being felt at the more sophisticated, larger shops that are into more sophisticated asset classes that are suffering. So we're doing some work on that. But overall, we need to be more profitable than 64 basis points. I know that for some, they say, wait a minute, it's a non-for-profit industry. What are you talking about? That level doesn't matter. We have a saying over here: if it don't make sense, it don't make dollars. And you have to make dollars because you have to continue to squirrel money away and retain earnings, because that is your war chest That's what allows you to fight for a rainy day. That's what allows you to build capital. And if you're not growing that capital and that retained earnings line fast enough, you're outrunning that rainy day fund, that cushion, that risk absorbing capital, and it's not good. Again, though, capital levels are pretty significantly high, historically high for the industry. Good as an overall measure, but not quite there for every credit union, if you will.
Now, great point. I don't think I have it based on what you just said there, what we said previously, nothing for me to add on that. I guess maybe other than one thing I always used to like to do is, and something I want to do when I see the December data is how many losers and winners were there, right? So the average is 64 basis points. You're saying the smaller ones might have some flexibility that normally would be, normally you'd see the better profit at the bigger ones as opposed to the smaller one. I always like to have the context of the 4,400 credit unions. What's the number that lost money? Because they're definitely on NCUA's radar. That is one of their risk reports, the loser report. So,
And it's
uh,
big this quarter. We were parsing through that the other day. It's
yeah,
significant. It's a significant list. It's not a short list this quarter.
yeah,
There were
yeah,
some pretty big impairments, some big numbers, some big write downs from some prominent folks.
yeah. And if you're going to have a loss, you might as well have a little bit bigger. My advice always with credit unions when I was at the supervisory level or lower was rip the Band-Aid off, right? Don't cherry pick and go, gosh, we're only losing 20 basis points this year and then lose 30 basis points the next year and then 30 basis points the next year, right? If you've got allowance to deal with, if you've got some other bad decision to write up, reposition yourself, get to the bottom the first go round, and NCUA will view that better than you being on a one-time loser, two-time loser, three-time loser report. So it's a little late for that advice because everybody's filed their December. But next year, keep that in mind, listeners, if you find yourself in that boat. So consolidation, increased consolidation, we touched on a little bit. I know you're seeing it. I know I'm seeing it. You talked about it in the newsletter. General thoughts on consolidation as we see here today, early February?
Yeah, I mean, 2024, big year. The credit union for bank style transaction is out there in spades. Last year was a record setting year, 22 of those, I think. Again, like I said, we kicked off the year with one big one in California. There are more that are in play, certainly. And we're seeing a lot of those banks quietly shop. Credit unions are good buyers. Certain jurisdictions, they're not because the legislatures have seen fit through a lot of twisting of arms from the bank lobby to make a rule or to have folklore that basically says credit unions buying banks is no good. But that's a small select few states. For the most part, this is still open for business. The NCUA has been supportive. Those bank transactions are fairly dilutive to capital, and so you have to keep your capital level in the screen when you're on the radar when you're doing those. Not only your PCA net worth, but also your risk-based capital. Understanding the effects of those transactions on intangible assets and goodwill and what you can carry, but we're going to see more of them. I think what we haven't yet seen as much of that I think we're going to see a lot of is branch deals. Here, we've done a few at Olden Lane. We've got a few more on the table here. I like the branch deal as a solution at the margin for some credit unions that want to uh, validate or optimize their geography. Sometimes you end up with a stray branch a distance away, and it honestly is better parked in some other credit union. And so you may want to swap out of those members and it can also enhance your financial ratios. It could be seen as a way to go back to core and protect a hub as opposed to a hub plus satellites. So we're seeing a lot of folks rationalize what they've got. And if it makes sense, they will part with a branch to another credit union. Two reasons why I see consolidation continuing. One is anecdotally, the amount of time in my day that's spent to that issue is just off the charts. So when my phone rings, chances are it's going to be on that subject. And the second thing is when you look at this industry, and I started down this road about a year ago on this particular statistic, and Chairman Harper picked it up. So I was either flattered or annoyed. I think I was probably more flattered. But if you break out the industry very crudely, and these levels are arbitrary, In the $10 billion club, and these are Q3 numbers because everybody's not reporting Q4, but in Q3, in the $10 billion or more club for assets, 21 credit unions. In the billion to $10 billion asset club, 25 credit unions. Below a billion, 100 credit unions. So 90% of this industry is below a billion. Now, a billion's not a magic number. We can do it down to 250, down to 100, wherever you want to slice it. But we've got a lot of credit unions that are below a level where many folks would think it's optimal to run systems that are accountable to members in terms of what they want best in class on mobile platform and solutions and payments and cybersecurity and compliance. There is a lot to do. It has a lot of cost. That cost is in what you pay your vendors and your solution providers. It's also in what you pay your employees. It's also in the strength, quality, and frequency of your footprint. And those are just big costs that honestly, it favors bigger players. So I just think the consolidation is going to continue. The other thing that's there is age. We have an aging population of C-suites. We have an aging population of board members. I don't know if this is a secret or not, but the 25 to 35-year-old set, they're not big into volunteering on the boards of financial institutions. They want, they like their free time and they want to be paid. So I don't know how long we're going to push that model. It's going to continue to be strained.
No, you're right. The boards are getting older. The staffs are getting older. On consolidation, the branch spinoff, I think, is good too, from the perspective of if you're having exam challenges and your net worth is you're in a situation where you might have to put a net worth restoration plan together, and the only solution is shrinking by reducing your rates or shrinking by cutting staff that you might need, is one way to do it for a year or two. But you get so lean that it can buy you time. But the spinoff where you're purging off a whole area that might be break even and maybe making a profit on the sale of it and quickly getting a little bit smaller footprint, I can see where that might make more sense long-term for some credit unions. I'm glad to hear that you're seeing some of that. And I think you're right that we'll be seeing more of that. You touched on cyber and the general regulatory burden that I think it makes it small. The harder and harder it's going to get for the smaller institutions. And again, pick a number on what you want to define as small. Technology, having to deal with the technology side of it. And then the buzzword last year and this year is artificial intelligence. What's your take on the technology and artificial intelligence game and how that impacts credit unions these days?
A couple things here. First thing I would say is the cost of admissions going up every day. The technology that you have to have, the expectation that your member has about the level of service you can provide is just getting higher. You need a best in class platform for online banking. You need payments that are very quick, very reliable, very easy to use. So you need convenience, you need reduction in frictions. Then you want to play offense. The best credit unions are playing offense. They're taking AI or solutions like it and they're using it for predictive results, right? They're trying to predict or improve certain processes, whether it be underwriting or account opening, and understand what their customers are doing. They're also using it to target marketing campaigns to cross sell. If you're not doing any and all of that, you're not in the top quartile of credit union. You also need it for defense. We need cyber. That's perfect. We can't have an attack or have any data breached. And we need data to have integrity and to be as robust as we can because we want to refine that data and understand it and use it in a predictive way. We also want to take processes and optimize them or make them more efficient. And that's typically some of that repetitive work is going to robotics. And here, again, we have some tensions, right? We have the gentle ladiness of our industry. We have folks that we respect who do jobs, but we also have a cycle of technology or innovation that can replace some of those jobs. So we've got to do it smartly for the good of the institution, and we've got to do it with a heart. But we've got to be moving to a posture that allows us to do the things we do better, quicker, faster, more reliably, perfect, and then figure out what's next. So it's a tall order. And again, one of the things I worry about, I do the board meetings, I go around the circuit and I talk to our board about X, Y, or Z or strategic planning. When I probably shouldn't do this, I'm probably get myself in trouble. But I go to some of these credit unions and I say, okay, I just looked at your last presentation and it's all about what we're going to do in technology. I said, who on the board has a technology background? Raise your hand. And it's invariably zero. And the other thing is we will pound the table and talk about how the lifetime value of a 25-year-old is significant to us. And we've got to turn over our member set. And we've got, as much as we respect the people who are with us at 75, they're not taking out loans anymore. And they are very predictable and very stable. We've got to find 25-year-old customers who can come with us for a lifetime. But we don't have any representation of 25, 30-year-olds on the board. And I would argue they know as much, whether they know it formally or have as much experience, they know things that your average folks my age don't know. And I would encourage all of these boards to at least have one member who's in that set because I work with them all day over here and I'm amazed at what
Sure.
these guys can do. The folks we work with on our team, what they can do with data, what they understand about social media and the way it interfaces, it's staggering. And you're drinking from a fire hose to try to keep up with them.
Yeah, that reminds me of a book title I quote a lot, The Wisdom of Crowds. And if your crowd is it's nothing but 75-year-olds or 775-year-olds and 260-year-olds, you're going to reach different decisions than might be optimal for the future and the members that are going to make need loans, et cetera, et cetera. So that's great advice. I think it's probably the biggest challenge facing the industry right now is capturing the youth market and being relevant for those folks 5, 10, 15 years from now. So we've talked a little bit about the election and the got a couple more here before we wrap this up, but the Trump effect. And we were talking a little bit before we got on that maybe even the Trump effect that you wrote the article on 10 days ago might be a little bit different than the Trump effect today. But the Trump effect, let's talk about the impact of that on credit unions as you see it.
I would say very crudely at 20,000 feet, two things to emphasize. Number one is philosophically, politically, whether you agree with it or not, we should pivot to a pro growth, lower regulatory environment. I think it's going to take a little time to get there practically, but it's clear that's where he wants to be, right? So he is going to encourage growth. He's going to encourage less regulation. Okay. Getting there, I think, is more interesting to look at. So if you look at what we've already seen out of the new administration, we've seen a hiring freeze and we've seen a return to work order. Those are the two that I'm focused on for a second here. The hiring freeze, I get what you're trying to do. You're trying to shrink the size of government or stop it from growing. The return to work, I get what you're trying to do too. You're saying, how long can we run this COVID thing out? And this has been a luxury that honestly we don't need from a medical standpoint anymore. I get it too, philosophically. The issue is, and this as well as I do, the folks at these regulatory agencies don't exactly live there anymore. And so a return to work order is not as simple as I just turn back on my monthly card and get back on the transit system and go back to work. A lot of folks have moved out of the area. And I believe some of the more senior folks are going to take this plus the offer of a buyout and say, I'll take it. I'm just not going to return to work. It's not, the lifestyle, the expectation I want at this point. And therefore, you're going to see a brain drain at the top. We can argue about how big that's going to be, but I think it's going to be significant enough that it matters. Bring behind that the hiring freeze. You're not going to be able to replace those people from a body count standpoint. Either way, you're not able to replace them from a knowledge standpoint. So you're going to have a vacuum. And what worries me about the vacuum is some of the things that we're trying to do at an Olden Lane, for example, they're not the everyday thing, right? So when an institution, a regulatory institution like the NCUA shrinks like that, they're going to play defense. They're going to do the things that are absolutely necessary. They're going to do the things that they have to do for their day job. So exams will continue. They're not going to let people off the hook on that. And so a lot of the time that is spent on the things at the margin that we try to do here, whether it be an application to issue subordinated debt, or a merger application, those can go to the back of the line, the back of the queue at the agency, and tend to get less attention. Now, maybe we just enter a regulatory environment and a change of guard that says, all right, just wave them through. I wouldn't suggest that because I think the agency does a good job of being gatekeeper on a lot of these things. And frankly, we try to keep up with what their expectations are. But I do think you'll see a backlog. We already saw it. Some of the bank deals we've been working on have just been slowed. The FDIC has not gotten to visit on their normal pace. And so I worry about operational tempo at the agency and how that's going to affect credit unions, especially in a dynamic environment where you've got to be more nimble and quicker with your decision making. So that is one thing. We have a pro growth posture. We may have a frustrating implementation. The other thing in the soup at the NCUA is the changing of the guard we spoke of earlier. Harper out, Hauptman in as chairman. Hauptman in as chairman with two Dems on the board. You tend to get the dead situation. You also have Hauptman taking orders, probably more than usual, from the main house down the road in Pennsylvania Avenue, and trying to implement those into a difficult political slash personnel environment. It's going to be, I think it's going to be tough. It's going to be choppy here for a little bit.
No, it's very astute. I agree with everything you said. And when the hiring freeze first came out, I chatted with somebody at NCUA through the grapevine who said, yeah, we just met on this. Exams come first. So the thing you said is exactly what they communicated to their executives right out of the gate. And they communicated that to their examiners. When they offer buyouts historically, the only thing that happens is people either feel like they won the lottery or they ignore it because they're about to retire and they go, wow, look at, I get X amount of dollars and I was going to retire in 6 months. Those folks, it's heck yeah. Where do I sign up for it? Nobody else leaves other than the people who are going, gosh, those are some good people that are leaving. We have the hiring freeze on. I'm already the go-to guy in this division or go-to gal in this division. And guess what? The top performers, the pressure on them goes up. And the top performers are the ones who have options to leave and might be able to pivot to another industry. They can't really pivot to another government agency right now. But yeah, I think you'll see opportunities where some folks will be going out into the credit union land, perhaps, or going out and consulting, et cetera, because they have options. And so then you layer on top of that, there hadn't been a real economic issue. We talk about the rates having been low. It was easy to make money. Everybody was doing things and the exams got easy, the jobs got easy, and then rates went up 500 basis points. And you've got examiners dealing with things that they hadn't seen before, right? And they've maybe seen it now for 6 months, but that corporate knowledge you lose by chasing away some of these people is going to have ramifications on every federal agency. It'll have ramifications on and again, stepping aside of whether or not government's too big and this needs to happen or not, there will be these ramifications. On the hiring freeze, just out of curiosity, the other morning, I went to usajobs.gov because that's where agencies put their jobs. And I thought, well, I'm going to go see if anybody was dumb enough to leave up job announcements. And I checked 7 or 8 agencies, including NCUA, and none of in the big agencies, no job vacancies came up. So that's where you'd probably get called over by Pennsylvania Avenue saying, hey, there's a hiring freeze on. Why do you have these announcements up? When they turn that spigot on, I'll have clients where NCUA, they do commercial loans wrong, and NCUA will say, you need to cease commercial lending. You're increasing the risk of the insurance fund saying I need to cease. We need to come up with some sort of pocket of things that you think I'm doing okay for whatever reason, so that don't make me say we don't make these loans anymore because I'll never be able to turn the spigot on. When you turn that spigot off and say you're doing no hiring, gearing it back up, let's say it's 3 months before the freeze comes off. Who knows? It might be 4 years. Let's say it's 1 year. Whatever it is, whatever carve-outs they make, turning those spigots back on, getting those announcements back out so that you have to have it out for a certain number of days, then you have to get it in and you have to review it, and you have less people to review it. Oh, by the way, on top of the fact that are people going to want to come and apply with all the angst that's there? So it's creating some serious angst and mayhem at all of the agencies, some more, without naming names that are in the press, but some more than others. But yeah, it's a good time to be a consultant thinking about how this is impacting NCUA as opposed to being over there, because I know there's a lot of anxiety as they're trying to do what the administration wants. They're trying to meet their mission, and they're trying to carefully take care of the employees that help them achieve that mission. And some of these, just like it's hard to be profitable in this soup that we're talking about, all those things and these challenges are the agencies, including NCUA, are facing right now. Of clicks and mortars, I love that headline of clicks and mortars. So let's talk about what that topic and what that means for credit unions.
I think it's trying to find the optimal balance between high tech and high touch. So it's what is the right presence from a branch standpoint versus from a digital standpoint. And this is going to vary by credit union. It's going to vary by your history, your culture, the makeup of your members. It's going to vary by geography and how people bank. But banking has changed. And if you don't see it or understand it, all you have to do is take my mother as an example. She used to not dust the computer because she was afraid it would do something. And, and when COVID came, she had no choice but to access her account on the computer or the iPod. And she figured it out. And she's now a deft mobile banker. And it's funny, at the very first quarterly report of JP Morgan when COVID set in, Jamie Dimon said, when we look back on this, it will have done what I couldn't do with a team of technicians over a 10-year period. It will have forced people in a certain age group to change their habit and access accounts online. And that's a blessing in many ways because it allows us to do things uh, without the physical presence and the cost of that physical presence. But we have to be careful because that physical presence still matters to some. And again, it's going to vary by what style of business you have and who you serve. It also has a billboard effect. It also has some knock on community effects. If you think of your branch as more than just a place where people deposit checks and wait in line, a lot of the credit unions that are progressive are turning their branches into financial education centers. I can think of certain clients we have who are very deep into that mission and understand it as both a community center and a financial resource. I will say there's a couple of things from a socioeconomic standpoint. Some of the surveys talk about how the interaction of people is at an all-time low across all cohorts, all swaths, all socioeconomic statuses. And I think credit unions, particularly community credit unions, can play a role here that's more broad than what they sometimes see their vision as. Before I got on this podcast, I was gonna joke with you. I just saw that the average American speaks 3,000 fewer words today in a day than 2 decades ago. And that is because they blame social media and they blame texting as a communications medium. Now, I'm solving that problem by going on a podcast binge with you. I just want to
Right.
remain as loquacious as ever. But credit unions can fill that gap in communities. And there are credit unions who are doing some interesting things. Rick Weber out on the West Coast at Ocean Air, which is the old CBC, he's put his branches into the Department of Motor Vehicles, or he's got Department of Motor Vehicles services in his branches. He's also put branches in Dunkin' Donuts or Dunkin' Donuts in his branches. I know that Matt McCombs at Vibrant out in Moline in the Quad Cities area, he's turned a lot of his branches essentially into coffee houses. They're fully functioning restaurants, and he's building a sense of community. And he's going about deposit gathering in a very different way. He's created an affinity card, and folks get rewarded for carrying balances, and that reward is affected in the price of their lunch. Those are different approaches. They may not all win. They may not all make total sense to every credit union, but it's great to see folks that are innovating and understanding that the branch and the digital and that optimal mix across their membership is really what it's about.
Yeah, boy, that's a lot of powerful things you said there, but that 3,000 words less a day, that has ramifications. And if you can help people create a sense of community like those examples that you gave, that's fabulous. And you talk about your mom. I have the same thing. I help her with her taxes. I help her with her investment account, and she very proud that she's never put her credit card into the ethosphere out there anywhere. And when I help her with their taxes every year, I'll tell her I need her social security number, and she'll forget that I did it the last year. And she'll say, okay, I'm going to give you the first three numbers and I'll call you and hang up, and I'll give you the next two, and then I'll give you the next four. And then at the end of the third call, I always say to her, I said, okay, just to make sure I got that, let me repeat it. And she goes, oh,
My mom, the same way. Interesting. She's had some issues with things in the mail, checks. And so we're learning together.
yeah,
The threshold for wiring money is a lower number now when she does things because avoiding checks, just changing kind of the way you bank for a whole host of reasons. And it's unique to each person. Credit unions provide an incredible service in that they're able to tailor their solution to the needs of the customer, whether it's
right.
a small business or person or a sophisticated person or a less sophisticated person. And honestly, that's what at the end of the day is so rewarding about what I do an awful lot of visiting the credit unions. I go to see folks all over the country. I love spending time in the lobby, just observing, just watching what's going on,
Absolutely.
seeing how people bank, understanding what they're doing differently and what solutions work and don't work. It's
You got it.
fascinating.
Yeah. Yeah. And my mom still has her account. My dad worked for the telephone company. He's since passed, but she has her account there, and she had to go do business there. And she's talked to the same teller for 25 years. And that's the credit union way, which is really cool.
Yeah.
So lastly, we've talked about aging leadership. We've talked about aging and a couple different, couple of the other 9 points first. Anything else to add on aging leadership that we haven't hit here yet?
Now, one of the themes we talk about here, because it's not said enough, honestly, is NCUA was on this, right? They did a succession rule last year. We can argue again at the margin. We did a comment letter here that's accessible on our website. I thought they didn't go far enough. I would have loved that they pressured it a little harder. I also think sometimes regulatory agencies are immune to how much things cost. They did it in sub debt when they forced people to go get a lawyer and didn't have a de minimis exception. So you've got small credit unions raising small amounts of money and paying fees to lawyers that are unnecessary. And they did it in succession planning when they insisted on a certain format and a certain credit unions can't hire people to do that. And if they do, it's more cost. Or you're going to get something that's boilerplate and it doesn't really answer the needs. But for the most part, it's an issue that has to be confronted. We have to be straight up about it because C-suites plus boards are getting older. And we've got to figure out how to capture younger folks into this market. I will say we work with an incredible number of newer C-suite people who are extraordinarily talented, who come from less traditional background, different. They didn't grow up credit union, right? Some have now come from the banking space. Some have come from the consulting space. Some of the CFOs that we see are very adept at reading balance sheets, at understanding the levers at a credit union very quickly, and are progressive in their thinking. And that is very welcome development because we're going to get there with experimentation, smartly done, and with pushing the envelope where it makes sense. Because doing things the same way tomorrow that we did them yesterday, because we did them that way, it just doesn't fly anymore. It's the most exciting time to do things. We talked about AI. What some of the guys in my office are doing with AI is unbelievable. You got to be careful, and ultimately you need a person that's responsible. But this is the most exciting time to do business. It's the most exciting time to have clients and customers, and it's extraordinarily rewarding if you come to work and you work hard at it every day. And for Olden Lane and its clients, it's a gift to have what we have here and to continue to be able to do this every day.
Perfect. Said. That's a good wrap. If someone has listened to this and they want to reach out and chat with you and your team about this podcast, any topic we talked about, or the things that Olden Lane is offering for credit unions that you summarized on the front end, what's the best way for someone to reach you, Mike?
I'm on LinkedIn, pretty active. Olden Lane has a page as well. We have a website. It's www.oldenlane.com. And we've got a box on there that says contact, or we'll send an info to a whole group of us over here. And we'd love to speak to any credit union, large or small, about any of these issues. So we just think we're part of the mission, trying to help, and we'll do anything we can to help credit unions do the right thing by their members.
You got it. I've seen it in action. That's a fact. Thanks so much for your time today, Mike.
Really appreciate it, Mark. Thanks a lot.
Got it. And listeners, I want to thank you as always for listening. Mark Treichel signing off with flying colors.